Type one word in the comments right now, Hormuz. One word. I need to know who in this audience already understands what that word means for your physical silver position. Not next week, not after the Monday open. Right now, type it. This is the Asian Guy, March 6th, 2026. Silver is at $84.34. Gold is at $5,172. Those numbers are wrong. Not a data error. They are the price of yesterday's reality still displaying on today's screen, same as a patient monitor showing the last reading after the signal has already changed. Here is what changed. The Strait of Hormuz, the 21-mile choke point through which 20% of global oil supply transits every single day, is effectively closed. Qatar has halted all 1.8 million barrels per day of production with no timeline on resumption. Maersk, responsible for 17% of global container freight, has pulled every vessel from the region. Drone strikes, active naval engagements, and insurance underwriters who have stopped covering the routes entirely. Brent crude is at $86 and directionally uncapped. Meanwhile, mainstream financial media is running wall-to-wall jobs report coverage. Payrolls missed. Powell might adjust in June. That is the story they chose. The institutional desks that understand what a closed Hormuz means for silver's production cost structure are not watching payroll data right now. They are placing orders. The window you have to position before those calls complete is narrowing on a Friday afternoon, with paper markets hours from going dark all weekend. $84.34, the pre-Hormuz price. It is not registered what occurred this morning. It did. Nothing here is financial advice. I track the intersection of energy markets, precious metals cost structures, and the spread between paper contracts and what a dealer will actually charge you for an ounce. Publicly available data. Do your own research, especially if you trusted the institutions that called inflation transitory in 2021. Silver does not appear. You cannot print it. Every ounce runs through a production chain that begins underground with diesel-powered excavators, moves through energy-intensive crushing and chemical refining, and ends with petroleum-fueled freight networks crossing continents. Every link is an oil cost. At $70 per barrel, energy embeds $8 to $12 per ounce into silver production economics. That range is baked into every mining company's financial model, every Wall Street price target, every futures contract written in the past decade. Oil is not at $70. Brent is at $86 with no natural ceiling, while 20% of global supply sits behind an active military engagement zone. No Saudi spare capacity is being activated. No strategic reserve draw offsets 21 million barrels per day of Hormuz throughput. Run the arithmetic. $100 oil. Energy cost per silver ounce moves to $15–18. $120 oil, the level crude hit during the 2022 geopolitical shock. Energy cost approaches $25 per ounce. Add shipping insurance repriced by underwriters watching the world's second-largest container operator abandon an entire trade region in a single announcement. Add the capital risk premium mining executives will require to operate in violently volatile input environments. The cost floor does not reverse when hostilities end. It resets to the new capital environment, permanently. Scale this precisely. Saudi Arabia, UAE, Kuwait, Iraq, and Qatar all funnel crude through 21 miles of water. Qatar's 1.8 million barrel per day halt is already offline with no resumption timeline. No rerouting option absorbs that volume. The Suez Canal cannot. The Cape of Good Hope adds weeks and cannot handle the throughput. Maersk's withdrawal extends the damage beyond crude. Maersk does not move oil. It moves electronics, industrial inputs, chemicals, manufactured goods, and raw materials. When the company responsible for 17% of global container freight abandons a trade lane because underwriters refuse to price the risk, the disruption has extended into the broader supply chain architecture. Refined silver, moving from processing facilities to industrial buyers in Europe and Asia, transits that same collapsed infrastructure. Two forces simultaneously. Production economics permanently repriced upward. Physical distribution of refined metal compromised in transit. The paper price at $84.34 has processed exactly zero of this. The market has answered this question 3 times in the modern era. 1973, OPEC crude moved from $3 to $12, a 4-fold cost shock transmitted simultaneously through the entire global economy. Inflation hit double digits. The dollar shed 30% of purchasing power. Gold ran from $35 to over $800 by 1980. Silver moved from $150 to $50, a 33x return in less than a decade, driven entirely by the market's recognition that fiat currency cannot absorb an energy shock without debasement. The critical structural difference from today: in 1973, global debt was measured in billions. The Federal Reserve cannot replay the Volcker playbook with a $36 trillion national debt, generating over $1.2 trillion in annual interest at current rates. The policy tools that broke the 1970s inflation cycle are structurally unavailable. China was not importing 10 million barrels per day in 1973. The 1973 episode is not the ceiling for what follows. It is the floor. 2020, paper silver cratered on COMEX. Simultaneously, silver eagles were unavailable below $8 over spot at any major dealer. Delivery windows stretched to 12 weeks. Paper said one price, physical said another. When the gap closed, it closed violently, locking out everyone who waited for chart confirmation before acting. 2023, regional bank cascades produced identical mechanics. Premiums hit $10 over spot. Dealers rationed purchases to 100 ounces per transaction. Same architecture, same sequence. The current structural departure. Global silver mine production has run flat for 5 consecutive years at approximately 830 million ounces annually, while total demand exceeds 1 billion ounces. The annual structural deficit of 170+ million ounces has been sustained by drawing down above-ground stockpiles already in decline before this morning. The Hormuz closure did not create the deficit. It removed the buffer absorbing it, while simultaneously accelerating demand from solar fabrication, EVs, and industrial electronics that cannot substitute a round silver. The deficit does not resolve under energy shock pressure. It compounds. COMEX does not require physical silver to exist for a contract representing silver to trade. The exchange operates on the assumption that the overwhelming majority of contract holders are speculators closing positions in cash before delivery becomes a question. Independent analysts estimate the paper-to-physical leverage ratio runs between 100.1 and 250.1. For every deliverable ounce in registered COMEX vaults, between 100 and 250 paper claims are simultaneously outstanding. What most coverage of this event has missed entirely, Basel III's net stable funding ratio, fully implemented by European banks, now requires 85% stable funding against unallocated silver positions. This regulatory structure was specifically designed to compress the fractional reserve mechanics of paper metals markets. The measurable outcome, COMEX registered silver inventory has declined from approximately 150 million ounces in 2021 to under 100 million ounces entering 2026. The fractional reserve buffer going into this event is materially thinner than it was during either 2020 or 2023. In stable conditions, the leverage structure functions. In a structural energy shock layered on top of a thinned registered inventory buffer, it is a detonation device. When institutional and sovereign wealth demand for physical delivery exceeds what registered vaults can honor at the paper price. The separation between paper and physical is not gradual. It is violent. That is the architecture. The mechanism is already in place. The Hormuz shock is detonating inside a 50-year monetary architecture that was already fracturing. The petrodollar system, constructed in 1974, manufactured artificial global demand for U.S. currency by engineering a single rule. Every country that needed oil needed dollar reserves. That manufactured demand allowed the United States to run persistent trade deficits, print currency beyond its productive fundamentals, and maintain geopolitical leverage through control of settlement infrastructure. It is now coming apart, and Hormuz has accelerated the fracture exponentially. China imports over 10 million barrels of crude per day through routes running through a closed choke point that a conflict the United States is central to controls. The Chinese response, built systematically since Russia's central bank reserves were frozen in 2022, is deepening bilateral trade infrastructure that moves energy purchases outside dollar settlement entirely. Saudi Arabia is in active negotiations to accept yuan for oil. The UAE has been settling trade in dirhams and rupees. Iran has been selling crude to China in yuan and gold for years. This is not theory. It is operational infrastructure already running. The 2022 Russian reserve freeze delivered one message to every country with geopolitical tension with Washington. Dollar-denominated reserves are subject to seizure by decree. Central banks globally purchased over 1,000 tons of gold in 2022, the highest annual figure in decades, concentrated in China, Russia, India, and Turkey, continuing through 2025. China's official reserve stands at 2,264 tons. Analysts tracking shipping data and refinery capacity estimate real accumulation between 4,000 and 6,000 tons. Russia grew from 500 tons in 2010 to over 2,300 tons today, explicitly described by Russian officials as a strategic instrument for reducing dollar dependency. The paper price at 84.34 is not just lagging the energy shock, it is lagging the monetary system transition, the energy shock just accelerated by years. The single tactical question on a Friday afternoon before paper markets go dark, the paper price is 84.34. That is not what you will pay. Pull any major bullion dealer right now. Silver Eagles and Maples are carrying $6 to $8 premiums over spot before the weekend has processed a single hour of the Hormuz closure. Real acquisition cost, $92 per ounce today. That premium is the physical market's unfiltered signal expressing actual supply and demand before the news cycle fully catches up. Sunday night, the Shanghai Gold Exchange opens as the first honest physical price discovery session since Hormuz closed. Asian institutional buyers, with the entire weekend to absorb the geopolitical context without a jobs report competing for attention, will be placing orders. Keith Neumeyer, CEO of First Majestic Silver, has publicly stated the structural disconnect between paper and physical pricing is approaching a breaking point. Sunday night's SGE premium above the COMEX paper price is the leading indicator for Monday morning in New York. Watch that number. It will tell you more than any analyst note published between now and then. The gap between Friday's chart and Monday's chart is not a buying opportunity, it is the price you pay for waiting. The critical difference between this episode and every prior one: permanence. In 2020, supply chains recovered. In 2023, banking stress was contained. Each time the production cost structure was intact and the disruption was reversible. The Hormuz closure repositions the energy cost floor of silver production in a world where the most critical input has undergone a structural reset. The window, premiums still in single digits, inventory still available, is open right now. Subscribe now and activate all bell notifications. If I go live Sunday night with an Asian session breakdown, you need that notification the instant it publishes, not 4 hours later when the move has already happened. Hit like. Every engagement signal directly counters the distribution restrictions this platform applies to precious metals content in 2026. Drop your biggest question in the comments. That is where the next video starts. Physical silver does not have a closing time. It does not have a circuit breaker, a margin call structure, or a counterparty whose solvency you need to evaluate Monday morning. The ounce in your possession is not part of a 100.1 leverage stack. It does not require a functioning COMEX. It does not require SWIFT. It exists in the physical world, not the digital abstraction the financial system is constructed around. That distinction is academic in stable times. It becomes the entire game when the infrastructure of the paper system comes under simultaneous stress. The global economy runs on energy. The global monetary system runs on confidence that paper instruments representing real assets are actually backed by them. The Strait of Hormuz is a simultaneous stress test of both. The asset that has survived every prior stress test across every geopolitical rupture, every energy crisis, every debasement event in modern history is the one a central bank cannot manufacture, a futures exchange cannot synthesize on fractional reserve assumptions, and a government cannot freeze by decree. 84.34, the price of the world as it existed before this morning. The price of the world as it exists right now is still being calculated. In Brent crude markets, in insurance underwriting rooms, in silver mining cost models, and in dealer networks repricing inventory before this weekend ends. When that calculation completes on Sunday night in Shanghai and Monday morning in New York, the investors who understood the gap and acted while the window was open will be the ones who come through with their wealth intact. Stay positioned, hold physical. I will see you on the other side. This content is for educational and informational purposes only. Nothing in this video constitutes financial advice. Precious metals markets are volatile. Always conduct your own due diligence before making any investment decisions.